Hi everyone, it's Alex King here at Recession Capital Research. Welcome to everybody joining this very special webinar of ours this evening. We have folks joining us from across all of our subscription services and also from the PAM community, so welcome one and all. We're going to talk today about how to understand the Fed, and that's going to be presented not by me, who doesn't know about how to understand the Fed, but instead it's going to be presented by Yimin, who writes the Macro Musings series for one of our research services that's in between his day job, which is running his own business. Yimin's background, he's a former pro rates trader, so this used to be his world in great detail, and so he speaks from a position of authority, does great work for us, and I think he has a great presentation for us all tonight. Before we move on to that, just a few words about Cestrian, for those of you not familiar. So we're an independent research business, SEC regulated, grown-up, professional, serious business. All we do is investment research, and we publish across many subscription services. You can find all of our services at cestriancapitalresearch.com, and you can see us on Twitter at Cestrian Inc. Those are on the screen right now. We're going to do a disclaimer, and then we're going to go straight to Yimin. So first of all, a long and rather tedious but necessary disclaimer. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Cestrian Capital Research, its employees, agents, or affiliates, including the presenters of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenters as of the webinar's date of transmission and are subject to change without notice. Companies referenced in this webinar or their employees or affiliates may be customers of Cestrian Capital Research. Cestrian Capital Research values both its independence and transparency and does not believe that this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so with that, I'm going to hand over to Yimin. Housekeeping rules. So we run on an open mic live basis here. If you have questions, points, anything at all, just unmute your mic and shout into the system. If you can't use audio or you don't care to, then there is a chat function in this webinar platform, and there's also a question function. Yimin will be presenting and talking, but I'll keep an eye on any questions or chat items that pop up, and when there's an appropriate moment, I'll interrupt. But if you've got an audio connection and you want to raise a point, just shout. So first of all, everyone is unmuted from our side, and now I'm going to make Yimin the presenter and hand over.
All right, thank you, Alex. All right.
Okay.
So welcome, everyone. Thank you for inviting me to this talk, and I'm honored to be here. Just a little bit of background for myself. I used to work for an investment bank in London, primarily trading G10, the major term currencies swaps, and short-term interest rates, meaning interest rate swaps that's shorter than 2 years. But I can trade longer ended stuff to hedge, and also very much focused on the US CAD market, Aussie dollar market, yen dollar market, etc. And as Alex said, this is not my day job, and I do have my own business, but I'd love to have this opportunity to help people understand more about the Fed, and just so I don't lose the knowledge. So let's start with the Fed's mandate. So contrary to conspiracy theories where the Fed serves the purpose of promoting elections, what have you, actually what they're really looking at is to create this condition of maximum employment and price stability in the US. And actually there is a third element to it, which is moderate long-term interest rate, but that's more like a result of those two conditions of employment and price stability. And the reason these two conditions are important is that if you think about a economy where people can find where the economy is not really is performing below its capacity, and people don't have enough jobs, then we run the risk of deflation and recession. Whereas if the labor market is too strong, and as we see now, inflation tends to spiral, and the economy is running too hot, and that makes price stability. That makes it very difficult to have price stability and therefore business planning. So the Fed is simultaneously targeting those two things. So let's go into the maximum employment. So maximum employment is not a figure. So there's no fixed percentage of where the unemployment rate should be. It's the concept that you can get a job if you wanted one. And there's a difference between unemployment rate and participation. So theoretically speaking, let's say there's 300 million people in the workforce working, but now there's more people looking for jobs, i.e. increasing their participation. Unemployment actually goes up even though no one has lost their jobs. So it's a function of how many people are getting a job versus how many people are looking. So the reason I brought this chart is that actually, if you look at post-COVID, the participation rate has never quite recovered to the pre-COVID rate. And the result of that is that the labor market is actually too tight. Too many businesses looking to hire people and not enough workers available for hiring. And as a result, we're actually sitting at a record low unemployment rate of 3.4%. And I actually checked the records. In the past decade, this is the lowest number we've seen. So currently, we're actually above a maximum employment. There is a 5 million gap between the work supply, the labor force supply, and the labor force demand. And why is that a bad thing? Because tight labor market essentially creates wage pressure. And wage pressure means that costs of services will go up, and that has a upward pressure on inflation, which makes the Fed's job of fighting inflation very difficult. So if you look at this chart from this is the past non-farm payrolls from the past year, we're actually getting a steady reduction of we're getting a steady deceleration in the employment up until last month. So that's why the stock market were actually spiking up in January, having a really good month in January. But since non-farm payrolls, we had a surprise number in the non-farm payrolls last month, and that's very much interrupted the theory that the inflation is calming down and the Fed is having everything under control. So now moving to the second part of the Fed's mandate. So now we're talking about price stability. So with price stability, there is actually a target number, which is 2%, and it's measured by the PCE. Up until 2020, just before COVID, the biggest problem we had in the US was actually not inflation, it was actually deflation. For a whole decade, the US struggled to get inflation consistently around 2%. So every time the Fed backs off, the price starts to decelerate again. So that's why in 2020, actually, the Fed introduced something called a flexible average inflation targeting. So instead of targeting a fixed 2%, they actually said, we're going to target a range, which is 2 and 2.5%. So that looks funny now because we're way above that range currently. But at the time, the biggest worry was actually hitting that 2% target. And to have price stability, one of the very important things we need is anchoring inflation expectation. And what that means is that it's not good enough that today the price, the inflation is 2% or 2.5%. We also want to create an environment where people expect that 2 to 2.5% to be consistent across the 10 years into the future. And that's actually even more, probably more important than the current inflation, because if businesses and consumers know where inflation is headed, they can plan their prices better, they can plan their spending better. With price instability, it's almost impossible for businesses to hedge their input costs, how much prices they should pass off to consumers, and vice versa. So if you've read Mohammed El-Arian on Bloomberg recently, you will see him talking about whether 2% is the right number. Maybe it's too low. Maybe we need 3% or 4%. And his idea of 3 to 4% inflation target is actually not new. Back in 2007, there was already a group of economists from Washington 2017, that wrote a letter to say, we think 2%, there's no evidence that 3 or 4% is worse than 2%. Maybe we should even target higher. But for the longest time, because we were struggling with deflation as a primary issue, that 3 to 4% talk has been kind of like shoved away until recently. So there's no real empirical evidence for this 2%, but that's where the Fed wants to target. And I think because we have a recency bias, where because inflation is so high now, we're thinking about 3 or 4%. But 5 years ago, 7 years ago, that wasn't the case. So what makes up inflation? So if you watch the Fed's FOMC conference, Powell actually is very specific about the different types of inflation the Fed is watching, and that's very crucial to how the Fed acts in the next few months. So the first one is goods, which makes up 25% of PCE. So these include like used vehicles, clothing, etc. And actually, up until last month, we've seen the beginning of disinflation, where the goods inflation was heading back towards that 2 and 2.5% range. So that was very promising. Housing-related services, and that's basically rental. That makes up another quarter of PCE. It has actually not really decelerated yet, but the Fed is very confident because this sector is actually very sensitive to interest rate moves. So with mortgage rates being so high, I think we made a new record like today. House prices will start coming down because there will be fewer loan applications, mortgage applications, and the rental prices should also adjust downwards when they get renewed this year. So the Fed is fairly confident about this part. But the goods and house-related services only make up less than half of the PCE, and the other half is actually non-housing related services. These things include like medical and transportation services, and a lot of the components, there's 6 or 7 components, but a lot of the key components in this sector are actually dependent on wage growth, which again is dependent on the tight labor market. So as long as we have an exceptionally tight labor market where the demand for labor cannot be met by the supply, we will have stickiness in the non-housing related services inflation for a while. And that's why tomorrow's non-farm payroll is very critical to seeing whether whether finally the labor market can slow down again or is still really tight. So what drives inflation? Generally, there's general supply and demand side factors. On the supply side, supply chain is a massive issue because the Ukraine war, Russian-Ukraine war, and also because of the COVID restrictions the past 3 years, goods cannot get transported out of places like Asia, Taiwan, China. So that has a huge impact on pushing the prices up. But we're seeing that those supply chain constraints kind of loosening in the past year, which has caused the slowdown in the goods inflation. On the demand side, so the demand pull inflation arises when simply people have more cash to spend. That's usually when people receive stimulus checks from the government, or when the COVID restrictions loosen, we have economic reopening, people start shopping and eating out and traveling. And the third factor, and it's an important factor, is the inflation expectations, which I mentioned before. Currently, very luckily, the inflation expectations have not yet slipped away. And you can actually measure what that is by looking at inflation-adjusted treasury bonds that's traded in the markets. There has been a pickup in those expectations in the 5-year and 10-year inflation-adjusted bonds, but so far we are still below 3%. So that's still very good for the Fed. And from my personal read is that there's no way Fed would revise the 2% target to higher, because as soon as they start doing that, the inflation expectations will slip away to 3%, 4%, and the good fight they've put up for the whole year will just be lost for nothing. So you may wonder, what is the difference between CPI and PCE? And we see two data points. CPI is typically mid-month, and PCE is at the end of the month. CPI is important because it gets released earlier, but it only focuses on the urban population, so it's not representative of all areas, especially the rural areas. Whereas the PCE is actually the preferred measure by the Fed, and that's where the 2 and 2.5% inflation target comes from. Over the past month, actually PCE and core PCE is excluding food and energy. Core PCE actually has reaccelerated, which is not good, and that's why we see bond yields spiking since in the past 2 weeks, and more crucially, the services sector is actually accelerated to 5.4%. So the Fed is highly aware of this development, and they're really worried that as soon as they pause, inflation is going to run away again. So that's why they just basically don't want to pause and hike until you see a tangible drop in the PCE. And of course, you could argue that they're backward looking because raising Fed funds rates to affect inflation will take around 6 months to feed through the economy. So the data today is should almost be adjusted backwards for 6 months. But the thing is, the Fed is also cautious that if they don't do enough, if they over tighten, they can always bring it back. Whereas if they don't, then they might run out of tools essentially to bring inflation back in line. So the Fed feels that the risk of under tightening is much greater than the risk of over tightening. So this is something you can track. So this is a global supply chain pressure index built by the New York Fed. So you can see on the page, it gets updated every month. As you can see, so this graph measures this so the standard deviation from normal prices in the past few years. And we can see that the supply chain pressure has eased substantially in the past year, which explains why the goods prices have dropped. But in January, it's ticked. In December, it picked up again. In November, December last year, it actually picked up again, and January it slowed down. But a lot of it is influenced by the delivery time out of Korea and China to the euro area. So this index takes into account of global transportation costs and also PMI, the Purchasing Managers Index surveys, especially in firms in China, Japan, South Korea, Taiwan, the US, and the UK. So we've spent a lot of time just talking about the Fed's twin mandate of price stability and labor market. So now we're going to move into how the Fed actually makes their decisions during the year.
Hey, Yimin, it's Alex here. It's Alex.
Hi.
I have a dumb question for you.
Go on. Yeah.
What do you think of the argument that says, well, inflation is just a function of the money supply, right? More money or more liquidity injected by the Fed, inflation up, money supply restricted, liquidity withdrawn, inflation down. What do you make of that?
So the money supply is actually so when we're talking about the Fed printing money, for example, during the QE period in the past couple of years, the money that the Fed creates is not a direct translation of the money going out in the economic system. So what that means is that the money first gets distributed around the primary dealing desk that deal with the Fed, who are buying and selling the treasuries of its balance sheet. And that money sits within those banks and then move through the financial system. And what you typically see is that risk asset prices go up first, but not necessarily the inflation in the real world. And it's a slower and a much more complete process than a one-on-one translation. But that also means currently, when the Fed is tightening, we also see that lag too. So you can see the risk assets being hit first because that money is not directly being withdrawn from the economy, but from the dealing desk of all those depository banks. And then it has a knock-on effect of on the real economy, and that usually takes 6 months to manifest. So absolutely, that's why for a long time everyone thought inflation was transitory, but it wasn't, because it took a while for that to manifest. And right now, the Fed worries that inflation is not coming down, but actually it might be. There's just a lag. So that's why the financial market was feeling that the Fed was bluffing up until now about raising rates higher. And also, the real answer is that currently nobody really knows how long it will take inflation to come down. But we just know that the Fed is very risk averse. On the conservative side, they rather over tighten. And back in 2020, they rather over loosen the monetary policy. So they didn't tighten quick enough back then, and now they might be over tightening. Yeah. So that's my take.
That's great. Thanks a lot.
So how does the Fed affect the interest rates and for the economy? We have something called the FOMC, where the Fed members gather around, and it's actually a 2-day event. The day of the announcement is actually, when we read the decision, is actually the second day of the meeting. And there are 12 members, voting members, and 4 alternate members. And all that means is that some of the people who, for example, Lori Logan from Dallas Fed, she's only voting this year, and she will be rotated off next year, and it will be someone else coming to her place from the regional Feds. So I would highlight that not all 8 meetings are equal. March, which is upcoming, June, September, and December are much more important than others, because historically, because these are the meetings where the Fed actually published something called the summary of economic projections, and that those projections contain what the Fed forecasts as economic growth and inflation in the next few years, in the next 12 months and few years. And they also publish something called the Fed dot plot, where each voting member would say where they believe the median of the Fed funds rates should be in the next 12 months, the next year, and the year after. We'll go into detail in the next few slides, but just quickly, so what are the Fed funds rates? The Fed fund rates is the overnight lending market called the Fed funds market by the US depository institutions. And essentially, when every day the US consumers and businesses make loads of non-cash payments through the debit cards, credit cards, etc., worth $2 trillion, right? To facilitate those payments, the depository banks have to hold certain reserves, reserve balances at the Fed. Therefore, each night the payments can be settled, and sometimes not a bank could be short on these reserves. They need to borrow more reserves from other banks, and sometimes a bank has excess reserve they can lend out. And the Fed funds rate is the rate these banks will lend to each other. It's actually a range. It's a 25 basis point range. And what the Fed does is that each night in the overnight market, they will take the median of those transactions. It could be, at 4.6, 4.61, 4.62%. They'll take the median and they'll say this is the effective Fed funds rate. And the reason is in this, things can be controlled in this range because the Fed can always lend lend reserves at what the Fed wants to lend at. And there's no incentive for banks to lend or borrow at abnormally higher or lower rates and lose money on them, because the Fed can always step in, right? So the range is always 25 basis points. Therefore, the increments is always 25 basis points and 50 basis points, etc. This is typical in the US, but it's not always the same. So in Europe, the European Central Bank and the UK Central Bank, they do in 10 basis point increments, and they sometimes do in 25, but the US is usually always 25 basis points increments. And we'll explain how we price them in the markets. So the Fed fund rates are typically forecasted by the Fed fund futures, which is the active markets traded on the futures exchange. And those futures are monthly futures that go out to 2 months, go out to 2 years. And beyond that, we derive what the Fed fund rates using other interest rate derivatives that are more liquid. And I think over here is quite worthwhile just to elaborate what the difference between terminal rates and neutral rates are, because you always see the term terminal rate in headlines. And all it means is the highest rate of the Fed will raise before the end of the hiking cycle, given the current inflation and employment situation. And this is the rate where the market is currently unsure. We'll talk about where it is at the moment in the future slides. But this is basically where is the Fed, how high is the Fed willing to go? In comparison, the neutral rate is actually the theoretical Fed funds rate, where the economy is neither is meeting the Fed's target of full employment and price stability, and the Fed policy is neither accommodative or restrictive. So that's actually the long-term rate the Fed is heading towards, using maximum employment rate and 2% inflation, which is where we are not at the moment. So what the Fed will have to do is we first reach the terminal rate, we might pause for a while, and we'll cut down the rates back to neutral rate. So you can actually see the Fed fund futures on retail platforms like TradingView. Those futures are calculated by 100 minus the price. For example, this is the September contract, and the yield on this contract is 100 minus 94.6, so it's 4.4%. 5.4%. So the Fed obviously the Fed meetings are in between the month. It's not always at the month end or the month beginning, so it could be the middle of the month. And the way this contract really works is an average of the Fed funds rates every single day throughout the month. I'll give you a very simple example. The first 15 days of the Fed funds, or 14 days in February, let's say is 2%, traded at 2%. The second half of the month traded at 2.5%, and therefore the contract should be traded at 2.25%. and therefore the price will be 100 minus 2.25 and 97.75. That's all it is. So using those futures contracts, you can actually derive how the market perceives the Fed's policy. And I've drawn this in this chart here. So this is actually the latest. I updated this just before our webinar. We can see that the market forecasts the Fed to go all the way up to 5.5%, stay for a while, and then start cutting down towards the neutral rate. So I've only got this out to 2024 because that's where the Fed funds futures are most liquid. So what is it? So when you read Bloomberg, they always say, "Oh, the traders price a 60% chance of a rate hike." So what does that really mean? All that means is that the futures contract has 15 basis point out of the 25 basis point priced in for this meeting, right? So for this meeting, and that basically is 15 divided by 25 is 60% chance of a 25 basis point. It's as simple as that. And when people say 60% chance of 50 basis point hike, that just means it's already over to 25 basis points. So we know 25 basis points priced in, and there's an additional 15 basis point on top of that 25 basis points. So 40 basis point price in the market translates to 60% chance of 50 basis point hike. And so every time I write the newsletter on Macro News, and always publish this table, essentially I use the futures contracts that you saw just now, and I'll work out where the market is pricing the Fed meetings for each meeting. And I try to map out as sensibly as possible to what the market think the Fed will do. So currently, we are projected to have three more 25 basis points hikes because this February one is done already. And there is a 40% chance of another hike in July because this 10 basis point pricing. We're going to stay at this level. The market think we're going to stay at this level up until December at least. And we're going to have the first rate cut either in December or January, most likely in January, because of how the market is priced. And then after that, we'll have four rate cuts in 2024. And when I updated those prices today, actually the market is 50 basis point higher than when I last published Seeking Alpha on a Substack. So in the past 2 weeks, the market has read Fed to go 50 points higher than before. So very hawkish. So as much as the Fed likes to communicate in advance what they're going to do, unfortunately, they usually don't actually get it right. And that's why the market always tries to call the Fed's bluff. That's why you see the market's fighting the Fed, or the Fed is being by the market, all that stuff. I've taken an example from 2021, which is actually just more than a year ago. The Fed in 2021 reckoned that this year we are going to reach a terminal rate of 2.5% on the left chart here, right? And looking fast forward 12, 13 months, February, fast forward a year actually. So same time the next year, the Fed is forecasting 5.5%, 5.25% to 5.5% as the terminal rate. So that's a 3 percentage points higher than where they thought it would be a year ago. So that is actually pretty significant forecasting error. And that's why the market is always a bit iffy when the Fed, when Powell says he's gonna keep on going, etc. The market doesn't always believe, because the Fed frankly doesn't have a great track record.
Yeah, also it's Alex here, also because they're forecasting something they're in control of, right? So that's not an inflation forecast. That's a Fed funds rate forecast. That's something that they control. So a year out, they're way wrong on a thing they control.
Yeah, exactly. Yeah. So it doesn't boost confidence for investors, and that's why you can see a lot of volatility when the data don't go the Fed's way. So just going through some very basic terminologies. You don't have to memorize this. It's just some jargons when you read Bloomberg to help you. So the top right-hand side here is the normal yield curve, right? It has a slope here. When the market says bear steepening, bear means prices are selling off, and what that means, yields are going higher. So when we say bear anything, it means the yields across the curve are going up, and the steepening means the far end of the yield curve is rising faster than the near end. So you can see this curve being a bit steeper in the far end. And bear flattening just means the yields going up, but actually the front end is rising faster. Bull steepening means yields going down, but the same change in shape. And bull flattening means yields going down, but the yields falling, the longer term yields actually rising slower or falling faster, should I say. One thing you should watch out is that those terminologies always refer to a normal curve, normal yield curve. So in the case when we have like an inverted yield curve here, if this yield here in 2024 goes up, that looks like a flattening move because the curve physically is flatter, but actually it's called a bear steepening move because it's always referring to the normal yield. So what's the relationship between bond yield and equities? So usually there's an inverse relationship between the bond yield and equities, and a positive correlation between bond prices and equities. So why is that? So imagine the risk-free rate, the Fed raises rates higher, and lending rates all goes up, and the Treasury yield goes up as well. And the Treasury yields, US Treasury yields, essentially represents risk-free rates, where you can always bank on the government paying you back. When that goes up to, let's say, currently to 4.1% in the 10-year, it makes other risk assets even riskier to invest in because it just makes the bar that's much higher. Other risk assets have to return way above the 4% you can get on the treasuries. So treasuries. And what also does is that those risk-free rates are being used as discounts on future free cash flows. And if you think about growth stocks, where every year in the near future, they're losing a ton of money to invest in future growth and future free cash flows, where you're really getting return is actually on 10 or 20-year horizon when they start becoming profitable and generating positive returns on your capital. But now those future cash flows are being discounted at a higher rate. So you're actually getting less present value for those future cash flows. That has a negative impact on how much you want to pay on those businesses. So it has an impact on your valuation multiples. That's one, which is what's largely driven the equity market down in the past year. But secondly, because of tighter financial conditions, there's going to be less demand from consumers. There's less willingness to lend money and borrow money, and debt becomes higher. It just makes economic growth slower. And companies will earn less. And we're talking now like we might have a recession in the horizon. Actually, I'm most certain that we will. I will explain why. But those two things, the impact on valuation multiples and the impact on your earnings growth, will bring risk assets down. So growth equities look less attractive. So it's a double whammy. And for the large part of last year, we are talking about the valuation multiples coming down, but now we're talking about earnings also slowing down from tech companies, which is why you should see them trading lower in this environment. We'll just bring up the graph. This is the 10-year treasuries in the yield in the upper screen, and the QQQ Nasdaq 100 ETF in the bottom screen. So they largely hold a inverse correlation. If you look here, when 10-year treasuries bottomed in August last year. Equities largely topped out 2 weeks later. And we're looking at this year when, again, treasuries bottomed in 1st of February, I think, and now making a new, almost approaching the new high. Equities also topped at the same time. In my last newsletter, I said we were likely to challenge the 4% bar, which now has gone over, and form a double top. I think we'll form a double top before the Fed really pivots. And the reason I think there is a recession coming is that the 2-year, 10-year treasury yield curve is currently deeply inverted. And what all that means is that the 10-year treasury yield is lower than the 2-year treasury yield. So, so the market is forecasting a rate cut in between those years, right? And historically, if you look at when we last had an inverted yield curve, we had it in January 1989. There was a recession after. We had dot-com bubble in 2000. Again, a recession after. We had in February 06, again, financial crisis after. We had it in 2019. And we had COVID after. But you could say that, oh yeah, COVID is an exogenous event. But actually, back in 2019, everyone already knew the economy was going to have a recession. It just happened that COVID exacerbated that chance. So now we're deeply inverted in this yield curve, minus 87 basis point. There's no real empirical evidence on whether this severity of inversion means anything about the severity of recession. But given the track record, we should definitely have a recession coming up. So we should brace for that. But that could mean, and what that could mean, is that as soon as inflation comes down and Fed has inflation under control, they might not have the luxury of pausing for so long, and we might have to price in a more aggressive rate cut cycle from end of the year, which is not currently being priced by the market. We have that, and that could be positive for risk assets for the reasons we just talked about. So coming on to our last slide, tomorrow, non-farm payroll. Non-farm payroll is always the first Friday of every month, very easy to remember, 1:30 p.m. Eastern Standard Time. And last month we had 500K job added, which is a huge number. It's a number we hadn't seen all year. But the economists, the Wall Street economists, has a consistent bias of underestimating the non-farm payrolls. So I've just copied the last two rounds where they were underestimating. But if you look back as far as maybe last 10 months, it was just consistent underestimation by the street. So either everyone's copying each other's numbers, or they're just all too pessimistic about the economy or optimistic about Fed cuts, whatever. But the economists have been wrong. So, but the thing is, now we know that the yield, if we look at the treasury yield, it's been going relentlessly from beginning of the month, from just above 3%, 3.25% to now over 4%. We had almost 80 basis point move in the 10-year, which is huge. So to what extent is tomorrow's number priced in? Even if we have a higher than expected number, which we almost certainly will do, given the track record, does that mean equities, bond yields will rally, will go up, and equities will fall? Not necessarily, because if you look at financial markets, and there's always an element of buying the rumor and selling the news. People position themselves in anticipation of a trend, and when the news gets announced, for example, the CPI, the non-farm payroll, or even the earnings release, actually the market usually moves the other way. So I wouldn't be surprised tomorrow that we get a big number again, but actually equities rally on the back of it, because there has just been so much move in the past month towards the other side, now I feel the risk is asymmetrical. But that's a very short-term read. But it's just from my experience, that's what could happen. So I've spoken for nearly 45 minutes now. We're getting to the Q&A. If anyone has questions, you're more than welcome to ask. Obviously, I don't know absolutely everything. If there's something I need to dig deeper, I can go away, do more homework, and come back next time and give you the answers, or in my next Substack or Macro Musings writing to answer those questions. But I'll try to answer as much as I can. Yeah.
It's Alex here. Okay, so look, from experience on our webinars, people are often reluctant to ask questions, especially the more esoteric the topic, the more reluctant I find people to ask questions. And that's because of all the usual reasons about worrying about looking dumb and all that. If people have questions, this is a great opportunity to ask. I can tell you that if you have a question, everyone has the same question. And if you are completely new to matters Fed, then your question, I guarantee, will be a brilliant question that will prove hard to answer and will educate everybody else. So please don't hold back. If you don't like to speak on these things, no problem, everyone understands that. Either pop a question in the chat box here, or alternatively, everyone will get a video of this session across our various platforms overnight, and there'll be plenty of opportunities to ask questions in the comments fields of those things. But if anyone does have anything they're burning to ask, points that they want to raise, do it now. Just gonna make sure everyone's unmuted side, which you are. So anything at all, do unmute yourself and chat. I guarantee it won't be a dumb question.
What are the chances?
Hey, this is Phil. I had a quick question.
Go ahead.
Yeah, so thanks. This has been really, really excellent. And this feels like kind of a dumb question, but often when I see the current Fed rate presented, it's always tends to be in a quarter-point range, and I don't get why it's not just a single number. Why is it always in a quarter-point range?
So that's a really great question. Let me just bring back to the slide where we'll talk about the Fed fund rates. So the reason is a range is actually because in this overnight Fed funds market where where banks are lending excess reserves and borrowing reserves, etc., it doesn't always fall on a single rate in that particular night, in that particular day. So in this range, so on the actual desk, people are trading. Let's say we start the market at 4.58, and there could just be someone really needing the money, needing the reserves in large quantities. Let's say a couple of $1 billion in one go, as an example, and it will push that rate slightly higher. And if the demand is the other side, it will push that rate slightly lower. So in this market, the actual transactions float around the target number, but it doesn't always trade on a particular number. The effective effective Fed funds rates number that gets published the next day is actually the median of those transactions. If the transactions go outside of this range, the Fed can always step in. It's unlikely it will happen, but let's say there's a liquidity crisis, the Fed could always step in and move the rates back in to this range. So that's why you always see this like 4.5 to 4.75. But but actually, it's on a day-to-day basis. It doesn't always. Individual transactions are not always the same number. That's just basically how the market on the day.
Okay, excellent. Thank you for clearing up that mystery.
We have a question from Ron. Ron, I'm going to unmute you now. Hold on one second. Okay, you're on.
Yeah. So, what are the chances that the Fed actually gets it right? I mean, the market's betting that they're wrong. So suppose they're right. It seems to me like this is a bit of a self-fulfilling prophecy. They're kind of driving the bus. Whether or not they're going in the right direction might be immaterial, but we're going to go where they want to go, right?
Yes. So one thing the Fed loves to do is to say that we are not predetermined on any fixed path, especially at this moment. And they are essentially what's called data dependent. They will assess what they need to do with every new data point coming in, the CPI, the PCE, the non-farm payrolls. So essentially what they're saying is that they could be wrong. They could be wrong, and that's what the market believes too. But if they are wrong, they have the ability. If they are wrong and they over tightened, they have the ability to adjust back. Whereas if they are wrong and they under tightened and inflation gets out of control, the tools they have to bring inflation back is much more limited. So they try not to corner themselves to say, oh, we're definitely correct. They're just saying, they're more like, okay, this is what we see. We think this is what we should do. But if the data contradicts us, we'll bring it back. Yeah, that's kind of what Powell is saying. So there's always this dynamic about his communication, trying not to mislead the market too much, but also he's trying to anchor the expectation at the moment. Let's play a scenario where the Fed admits they're wrong now. Let's say now they say, we don't know, we might be wrong. The first thing that's going to happen is not just the interest rates will, the yields will fall for sure, but one thing is that inflation expectation in the 5-year and the 10-year might slip away to 3%, 4%, 5%, because the market thinks actually the Fed isn't that determined to fight inflation, and there is very real possibility that inflation might upshoot. The Fed is very much worried about that expectation. That's why they even if they feel like they have to bluff, they still do it. Yeah.
I have a related question that has to do with the markets. Is there a ladder or a chart somewhere that shows how much the federal government owes at what different rates of interest, so you get a sense of how much of the national debt they're refinancing in a given year? Because it seems to me that they had a long run here where they could have, financed, trillions of dollars at near zero interest rate costs, and now they're in this very high rate environment, which seems pretty unfavorable for them. So is there something that tells you, when the Fed is rolling over and needing to refinance its debt and at what levels?
So the U.S. government, the U.S. Treasury always publishes a quarterly plan on how much issuances of Treasury they do, and they have to go to the market for it. So there is a schedule on how much that is. I don't have the number on top of my head, but it could be something like 20 billion a week, in that sort of range scale. And obviously, you're absolutely correct. When the Fed funds rates and obviously then therefore the Treasury yields go up, they have to refinance at a higher end, and high interest rate is basically very bad for refinancing, etc., for the government. So yeah, you're definitely spot on. There is a schedule. I can dig it out, and I can send the link in the next writing. Yeah.
So that becomes a constraint point for them, that the Treasury wants to have, I assume, the lowest borrowing cost possible, and the Fed's trying to tame inflation by driving driving the funds rate up. It seems that those two are counter. What do you call it? They're in opposition to each other.
Yes. So the problem is that the Fed the Fed is essentially a federal agent. So the Fed, for example, is not currently in talks about the debt ceiling, etc. The Fed's mandate is very exclusively on inflation and maximum employment, and doesn't concern itself with the Treasury borrowing cost, and that belongs to the Treasury borrowing. So you're absolutely right that the Treasury has a big problem in refinancing its debt at such a high level. But that is obviously the Treasury and the Fed talk to each other, but the Fed's mandate is actually to bring those two things, and not where the U.S. Treasury brings the refinances. Unfortunately, yeah, that's my understanding. So I think this kind of falls into the realm of like repo trading, treasury repurchase trading, and unfortunately, I'll be very upfront. I wasn't part of that desk, so I'm less transparent about what actually happens between the two agencies. Yeah.
You need to be on FinTwit and behave as if you're an expert in absolutely everything whilst knowing nothing. That's a much better place to be. We've got a bunch of other questions which we need to move on to.
Yeah.
Okay, a question we have here. Based on yield inversion and Fed continuous tightening, it seems like you're forecasting recession with high certainty. If so, have you ever seen the S&P 500 hitting a low before the Fed actually pivots?
Oh, so I actually did mention this in one of my previous pieces, in one of my macro musings a few weeks back. Historically speaking, the stock market never strikes a low before the pivot, before the Fed pivots. They nearly always hit a bottom when the Fed is near the end of the rate cut cycle, and that doesn't bode well for this year from that particular perspective. However, since COVID, we saw an acceleration of the market movement ahead of the Fed. And what I mean is that before the Fed started the interest rate hike, the market already topped in November 2021, before the Fed started its tapering and rate hikes, which was actually quite unusual. So I wouldn't rule it out this time around that before, well, I would say the market could race ahead of the Fed before the pivot, but historically speaking, it's never happened in the recent history. Yeah.
That's great. Thanks, Ewan. Right, next couple of questions. We'll try and rattle through these. Okay, from David Peterson, what do you think will be the effect on the 30-year bond on the 10th of March? David, is that your question? Do I understand that right?
Yes, that's my question. I mean, it's
So
not exactly big, just the effect of the 30-year bond as a result of the 25 basis point increase on Fed funds.
So I think my verdict on the 10-year is going to be very similar to, sorry, on the 30-year is going to be very similar to the 10-year because they tend to move in step. So the 30-year is trading at 4% and it's going higher, and it topped out at 4.4 before. It should try to make a move towards that high again, I think. But the thing with those bond deals is that a lot of it is about how far you forecast, what you predict will happen in the next few years rather than where we are immediately. So it's about whether the market, what's going to determine where that rate is going to go is whether the market thinks the Fed has overdone it. So therefore, the higher the Fed goes currently, for example, if the market thinks the Fed is overly restrictive, even if we go higher now after the FOMC does, and they do like a 50 basis point hike, for example, it doesn't necessarily mean the 30-year rate will go substantially higher, because the market might think the Fed has to cut more down the line because it's way too restrictive. Does that make sense? So I think it will move largely, the 10-year and the 30-year will move in line with each other, and the 30-year will move slightly less than the 10-year. My read on the 10-year is that we're going to have a double top, but it doesn't necessarily mean we're going to overshoot the previous top, because it really depends on how the market reacts to Fed being over restrictive. Yeah.
Thank you.
Okay, we have some more questions. So a follow-up on the S&P bottoming out is, so in other words, how likely do you this is a really easy question. You'll love this. This is like the question, right? In other words, how likely is the S&P low from October 22? How likely is that to hold if recession is about to come with high certainty? So if you can just answer that for us, Ewan, that'd be great. Yeah, what is the answer to that?
how likely is it to hold? I definitely think the bottom will get challenged again. What I mean is that I think there's room to fall between now and I think there is room to fall from now to double test the low that we made last October. That's my personal opinion. And actually, for the same reason I said before, like historically speaking, stock market doesn't bottom until the Fed pivots, actually deep into the pivot. So I think the chances are we could very well test a new low. Yeah. So that's my personal opinion. I think Alex has a different opinion, but
no, I'll tell you my own view on that. If you use, most forms, if you ignore anything to do with the real world, interest rates, any of that stuff, you just use pure technical analysis, you would say that the move up since October has been so sharp that even if you are a long-term bull, and I am, just as a sort of personal opinion, there's absolutely every chance that we can see a significant fallback without breaking that long-term up pattern. Just because the move up has been so sharp, it's been, it's taken, all bears have been taken very much by surprise, and you see, complete bear denial and so on and so forth. It's been a rapid move, and so just with the normal ebb and flows of securities pricing, I don't think there's any contradiction between it falling back, even significantly from here, and then moving up into a longer degree bull trend. So no, I mean, who knows, right? But I think that I don't think one needs to have a religious opinion on the long-term direction of the market to say for sure it could fall back from here. Just technically speaking. Okay, we've got a couple more questions to get through. Okay, one second, hold on. Oh yeah, this is a couple of interesting questions. How does the committee, the FOMC committee, actually decide on the rate? Keep voting until they reach a majority? Does the chairman have a casting vote? How does it work?
It is a majority vote. So if you read the statement, I believe at the end of each FOMC statement, it says what the vote was and whether it's unanimous, etc. So I do believe it's a majority vote. But the thing is, the Fed rarely has a huge diverse opinion between each other. They may do about okay. So actually, let's take one step back, because that question is almost not that important, because before each meeting, the market almost always know what the Fed is going to do, and the Fed is always the Fed is very interested in telling the market what they're going to do in the next meeting.
Yeah, because they tell Nick Timiraos at the Wall Street Journal, who tells the rest of us.
Well, exactly right. So they are very unlikely to have like a split vote in the thing. They want to manage the market expectation in what they're going to do next, down to the exact basis points. They hate miscommunicating about that. So the prediction for March. Well, for example, we have a meeting coming up on the 22nd of March. By the 20th of March, not even by the 20th, by the 18th or 17th, you will know what the verdict is. The latest I've seen them shifting was actually at the beginning of when they first did the 75 basis points, when the market was expecting 50, and they essentially told Wall Street Journal they're going to do 75 on the Monday. And then on the ones, and everyone shifted the pricing, and then on the ones they announced 75. So that's basically how it really works in the real world. Not all central banks do that, but the Fed definitely does. Yeah.
Okay. Right. I've got 3 more written questions, and then Tom will go to you on audio. Just bear with me a second, then we'll have to call it a day, because Yimin does actually have a business to go and run. Very grateful for him to do this. Okay. Just so hold on. So a couple more written ones. This is a great pair of questions here. Yimin, the first question, and I'll give you both questions at once. The first question is, could you give your opinion concerning why the Fed is not run by the federal government? That's part A of the question. And part B of the question from someone else is, given how bad the Fed is, why not replace the Fed with an algorithm and publish it on a blockchain so everything is transparent? So those are the two sides of the same question.
So I'll answer the second question first. So actually, one of the regional feds, icon, which I think it might be Cleveland's, actually does a algorithm on live update on the inflation they expect for this month, and they actually, so the algorithm actually predicts every single day. They will tell you where they think the inflation is for this month, and they get it wrong. So they got it wrong last month. So even with an algorithm, they get it wrong. So I don't think they're probably just as bad as each other, to be honest, in that case.
And why not just have it run as a department of the federal government?
That could be a historical reason. That could be more of a historical reason, because in the UK, the Bank of England is actually essentially appointed by the government, and they're getting their mandate from the government. But the Fed, I think, wants to perceive to be more independent and more away from the politics. But that's a very interesting history question, actually. So I will actually definitely look that up, and I might write it up, the answer, in the next piece. Thank you for asking.
For what it's worth, that for those of you unfamiliar with the London Central Bank, for most of its history, it was directly controlled by the executive branch of the government. In the 90s, it was made at least formally independent, and probably that's been an effective move from the inflation and interest rate control perspective, because it's not been able to sort of kick the ball around at the whim of the incumbent government to control, mortgage rates and so forth, to improve their chances of re-election. So that's a sort of shoot from the hip view rather than a data-driven view. But I think it's probably been a successful move, and so probably it's better that, in my opinion, that the Fed is independent, because ultimately all any government wants to do is get re-elected, and it's probably better that central banks don't run to a 2 or a 4 year cycle. It's probably better they at least try to look further out, in my opinion, anyway. Right, last question. Tom, you're on audio. Your mic's on. You're up. Tom, you still with us?
Yeah, I'm here. Can you hear me?
We don't hear you too well. Okay, Tom, I can hear that you're talking, but we can't hear you very well. Could you either shout into your mic or turn the mic volume up or something?
Okay, I'll try. Is that better?
Yeah, that's better. Much better, yeah.
Okay. Like I was saying, I'm in a bit of a quandary here, because I've been looking at, especially on some of the ETFs and the indexes, looking at like the Wyckoff charts. It seems they're pretty optimistic, and yet what we're hearing from these Fed analyses seems kind of scary. So what's going on?
Well, we speak independently here, so no one knows, obviously. So you're getting two different opinions. We even if we did have a formal house view, it wouldn't be imposed on anyone that put it forward. And so the equity and ETF charts you see are Sestrian charts, and Yimin is independent of Sestrian. He does great work for us, but he's independent of us. And so this is just two opinions. I will say that Yimin's written for us for a couple of years now, and his nose for where the Fed is going has been really good, really very good. And so you have to make the leap from there to the equities market. My own opinion, for what it's worth, is there appears to be a changing relationship between how the equities market treats the price of money and where the level of risk assets should be. And it's been a really strange sort of month in February, because although equities are down some, not down that much, but as Yimin pointed out, the 10-year yield mooned. I mean, just today it spiked on the jobs report, and equities were up anyway. So if you want my personal opinion, I think that risk asset markets are getting used to the idea of money that isn't free, and therefore if you like, the coefficient between where the yield curve is and where risk assets are priced is probably resetting into a slightly higher inflation rate environment. But that's just my opinion. That's based on limited data so far. But on matters, Fed credit rates, this is Yimin's world, not mine. My background is in equities, and so I would absolutely listen to his work on this.
So to be fair, like financial markets is always non-linear, and what used to work in a particular year doesn't always work. So the relationships do always change, and there's always a sense of reflexivity in the financial markets. So like this is definitely not a crystal ball to like the relationships sometimes just don't hold, and sometimes they hold really well. You just have to, but like I said, like my expertise is on the Fed side, on the interest rate side. When I think it was in December FOMC when investors, or was it in January when investors were thinking that Powell looked very dovish or like very unsure, and I actually stuck to the position that they are looking to raise the risk is actually raising rates higher than market expects, not lower, because you have to follow what the Fed sees. And of course, like the data, this recent jump in employment and inflation could be just correctional, but if you follow what the Fed sees and therefore follow the rationale on how they act, you could get a very good sense of where the rates are headed in the near term. Yeah.
Okay, we better finish up as we've taken a lot of your time. So on behalf of everyone here, thank you so much for doing this. It's been a fantastic presentation, and thanks for being so responsive to all the questions. Now, our attendees here come from all different places. Some of you subscribe to our services, some don't. If you'd like to get Yimin's work, there's two ways to do it. The expensive way is to join our Growth Investor Pro service that runs on Seeking Alpha, and the cheaper way is to join our Market Insight service that runs on Substack. We'll put a note out on all of our platforms. We'll email everyone that's attended or registered today, and we'll give you all the information on how to get his work if you'd like to get it. We do ask you to pay for it. It's premium quality work. We don't publish it for free, and we'll defend that all day long. But you'll get a note following or around the time of every FOMC and every major Fed event. And again, on the basis of a couple of years' work that Yimin has done for us, I can tell you it's really good stuff. So thanks to everyone for attending, and thanks so much to Yimin for running this. We'll post the recording in a few hours' time once the video is compiled, and just remains to say thanks everyone for being with us this evening. Thanks, folks.
Thank you, Alex.
Talk to you all soon.